thinking about buying or selling a home in 2023 and you're like, I don't even know where to begin. I have a 2.75% interest rate on my current home. Can I transfer that to a new home? Or would that be assumable for a new buyer? Or I have all my equity in my current home. How do I get that to my new home? And can I buy and sell? Or can I do it all at once? Like, what does this all look like? Or maybe you want to keep your property as an investment property. I am asking all the questions that you want to know to one of our favorite loan officers, Jason Trout, owner of JMT Mortgage. And he's dishing out all the goods, everything you need to know to successfully buy, sell, whatever you choose to do here in 2023. Let's dive in.
You're listening to the Girl Get Your Face Off a Bus Bench podcast, where we invite you to check your ego at the app, grab a cup of coffee, and get ready to dive into all things real estate marketing, social media, friendship, hardship, love, money mindset, and all the things that celebrate you as a badass boss babe.
We're here to encourage you, show up for you, give you a loving kick in the pants when you need it most, and be your soft place to land on the hardest of days. So pull up a seat at our table and get ready to be inspired and start living your best life by design.
Welcome to the Girl Get Your Face Off a Bus Bench podcast. We are so excited you're here.
Okay, girls, let's dive in.
Okay, bus bench babes. Today I have a guest that you have heard of before, and by popular demand, we're having him back because everyone loves to know what's happening in the mortgage business. So we have Jason Trout, the owner of JMT Mortgage. He's a local mortgage guy here in the Twin Cities that we love working with. So welcome, Jason. Thank you for being on the podcast with me today.
Yeah, you're welcome. Thank you so much for asking me to.
Yeah. Okay. So when you're not doing mortgages and you're not helping people find money to buy houses and refinance, what do you do for fun?
What do I do for fun? Well, I've got 3 boys who are very active in sports. That seems like it's always on my mind, always on the calendar. You know, before I schedule anything, I always check my calendar on my phone, continuously to make sure I'm not double booking and that things work out well for, carpooling and games and tournaments and things like that. That's probably my top priority. Otherwise, working on the house, working on the old Trans Am, or I do a bit of paid on-call firefighting for the city of Victoria, which I've done that now for about 8.5 years. So, yeah, no free time, but we love it that way also.
And you didn't mention your beautiful wife.
You didn't ask about that. Mean, for fun? I don't know. I mean, how do I lump that together with fun? Being married seems
You're like
to be
date
fun.
nights? What's that?
Yeah. That's all good. No, that all comes together. I guess after 17 years of being married, you kind of forget about that with the throes of being as busy as we are with everything besides work and stuff. And my wife's name is Lane, and she's working beyond full time. She's upstairs. We both work from home, so she is upstairs. She told me we're taking a mental break right now from event planning.
Yeah, you guys have your hands full with all the sports.
Yeah, for sure.
I for sure do.
Yeah.
Well, one of the big reasons why I wanted to have you on the podcast is that all the buzz this year, like ever since rates started going up last year in June, everybody wants to talk about interest rates and what they're doing, where we think they're going. And then I have a whole slew of questions like, ask the expert.
Mm-hmm.
So I'm just going to ask you all the things. How does that sound?
Yeah, fire away. I think I should be ready to go. I usually shoot from the hip anyway, so it's better off to not have questions planned out.
A big script ahead of time?
Yeah. I've got a piece of paper and some pen here, just in case I need to take some notes for anything, I'll Always got to be prepared.
No, you'll be
for
fine.
Beth.
You'll be fine.
Yeah.
I know.
Yeah. Whatever you want to talk
Okay,
about.
so literally, the burning question of the hour is interest rates. I mean, they've been a little bit flat here for like the last month or so, but where do you see them going? What do you see them doing this year?
From the research that I've seen, I mean, we all know how crazy this world is, and the markets are so just, ever changing and, just evolving. I really, haven't seen a lot of changes, I guess. In the past, year, I've probably seen interest rates on a 30-year fix, which is my most popular product. I've seen those swing from as low as, 3-4%. That seems like, a lifetime ago already on the low end, up to as high as about 7%. But they've been around that 6% to 6.5% range here over the last couple months, where I haven't seen a lot of change. I feel like there's just a lot of external factors, of course, that are playing in on where the interest rates are, what they're going to do. Ultimately, I am hopeful that they're going to be going down some this year. That's, I like to lead with a positive right there, is just to say, I've heard they may go down. They're possibly slated, depending on what you read. And of course, you can't always believe everything that you hear on the internet. But, it's a lot of blogs that I read and just news articles that I'm following and talking to people like yourself, Beth. You and I banter back and forth. We talked for, I think, an hour last week about, what's going on in the market and what's the interest rates going to do and what are they predicted to do. I mean, I feel like they may drop down. I've heard maybe as much as maybe 1% here, from where we're sitting in 2023. Although I just don't know. I don't feel any confidence really of like, okay, they talk about that, but when would that happen? Is that going to, there still may be a lag on when the interest rates may actually, take a little bit more of a dip into, say, like the low fives or the mid fives. I mean, to me, I kind of feel like the mid fives on a 30-year fix may be a little bit more realistic. But again, there's so many external factors. I had actually printed off something here. I'll just look at that. That's like the economic calendar for the month of May. And we all know that the Feds met yesterday, like they do, typically, and they raised the Fed rate another 0.25%. And I think the majority of people in the know kind of felt like that was going to happen anyways. So, the mortgage rates, they felt like they for like the 10th time in a row, the Feds were going to raise the Fed rate. And they ended up doing it. They raised it another 0.25%. The Feds are trying to desperately slow down inflation. And this is one of their biggest moves on that. Again, the Fed raising the Fed rate is not a direct connection to the mortgage rates. Like my mortgage rates did not go up or down really yesterday. But they really just, they anticipated that. And they're hopeful that things will, change for the better. But it may be still a lag. It could be a month. It could be another 2 months off, depending on so many more things. I mean, still the war, as we still talk about, happening with Russia. I mean, the bond markets, it's a huge, determiner of what happens with interest rates. I mean, stocks and bonds, yes, but if you got a lot of money moving in and out of bonds quickly, you may see kind of the fluctuation with some of those interest rates. So
It's crazy.
Yeah.
I saw an article right after the Fed had raised the interest rate from one of the, I think it's the chief economist from NAR. And he's like, well, it was something to the effect of like, well, it was expected. It feels unnecessary for that, this most recent quarter rate hike. And I'm like, well, I don't know. Hopefully it's doing what they want it to do. But I think we all could use some little reprieve with the rates, but it doesn't seem to be slowing buyers down. I think buyers last year were like, oh, whoa, we're not going to buy a house. And then now they're like, okay, this is just sort of the new norm. And we have buyers competing in multiple offers left and right. And they're like, we still want to buy a house because we need to buy a house.
Right. 100%. Yeah. From what I see is that the buyers now, the new norm has sunk in. And they don't seem to be they don't seem to be like scoffing at the interest rates where they're at right now, because you and I have done this long enough that we know this is where they were 20 years ago or higher. And, yes, it's up on the high side, but, housing is still affordable. It still is better than renting. Sure, a heck of a lot better than renting, making somebody else rich out there. And yes, this is one of those things of, it's a higher interest rate, but you can always have the ability to refinance. Because I think about my first house that I own.
That's what we just keep trying to tell our buyers.
Right. I love the saying, and I think I use it every time I talk to someone who wants to get pre-approved to buy, a house. Is these days, as I say that cliche saying of, marry the house, date the mortgage, because it seems like it just holds, more and more true. Like the first house that I bought in 2002, I bet I had refinanced 4 times before 2009 for a multitude of reasons, for changing the loan program from an ARM to a fixed, to taking cash out, to rolling like 2 loans into one, like paying off a home equity loan, paying off a first mortgage, or just taking advantage of lower interest rates just to refinance again right there. So, it's not the end of the world that if you get a higher rate when you buy your house, there is a light at the end of the tunnel, and hopefully that rates will come down and you can be able to refinance. If you buy and you've got a rate in the 6s, it's not forever.
Yeah. Okay. Help us understand. I think that, there's a lot of newer agents that listen to this podcast, and, I feel like I have enough information to be dangerous because I was in the mortgage business for years, but help us understand. And for the people that are listening that perhaps aren't in real estate and mortgages, like how is a loan priced? So like a buyer comes to you and says, hey, Jason, I want to buy a house. I've got a 5% down payment. I want to buy a $400,000 house. Like how is my interest rate calculated when you and I are meeting and I want to buy a house?
Yeah. Great question. So number one, I'll clear the air. It doesn't matter if you're self-employed or if you're an employee of a company. There's no discrimination. There's no different adjusters for that. So the playing field is very level to start that out. Now, the next thing is that, when I take an application for basically someone who'd be in pre-approved, typically I can knock that out in about an hour. So it's the application, the credit report. I'm kind of painting a picture for myself and a potential underwriter to send your file to. So what comes into play, what you're asking specifically about, is when I'm looking at your overall picture, it's again going to be your down payment. Okay. How much are you putting down? Are you putting 5% down? So now you're financing 95%, or otherwise that would be like 95% loan to value. Or are you doing 20% down? And then, you've got a 80% loan to value. So that, that's the big thing, is your loan to value for one. Number 2 would be your credit scores. So your credit scores are going to be the number one thing. And I actually now have kind of restructured my pre-approval process to, I do not specifically talk about the current interest rates, or if you don't put 20% down, you more than likely would have to have, PMI on a conventional loan. That's a private mortgage insurance. I don't quote rates or the monthly PMI until I have your credit scores pulled, because your credit score is going to be the number one factor as to, what's going to drive the interest rate behind everything. That's it. So loan to value, credit score has nothing to do with anything of how good looking you are or the color of your skin or any of that. It's just strictly a couple of those big factors for starters.
And then, so what does that look like? So do you have like base pricing and then there's adjusters for these things? Like talk through like the nuts and bolts of that.
Yeah, there are. There's definitely adjusters. So I'm just trying to think off the top of my head. If I was going into a website and I was going to price your loan right now, Beth, let's say that you were going to buy an owner-occupied property where the purchase price was $400,000. I know that would be one fact. I know you're going to put, say, 10% down. I know that fact there. Your credit is good enough and it makes sense for you to do a conventional loan versus an FHA loan, or those are probably the 2 big ones that I see. If you're not a veteran, well, you're not going to get a VA loan. So that's kind of off the table. But what I'm going to be doing is I'll put it in there. I'm going to put in your income. your income that, I'm estimating at what the underwriters are going to accept as your qualifying gross monthly income. Huge part there, your gross. The underwriters qualify off of your gross income, not your net income. So I put that in there as one of the factors. So I put in your zip code of where you're looking to buy. I put in there different types of programs. Are you doing, again, like I said, conventional, FHA? Are you a first-time home buyer? That's one of the things right there that I'll put in there. And so when I enter in all that data into my lender's wholesale pricing engine, then I click submit. It spins around the universe for a while and then comes back and it spits out, a rate sheet. And it's a rate sheet that has a rate stack. And say that rate stack would say, okay, here's the interest rates, excuse me, that you can offer for today. And it might be from 4.75 on the low end, all the way up to 7.625. And that's actually one of the things with the anti-steering disclosure I have. I have to show you the range of interest rates of what I could lock you in that day when I go to lock you in. Now, of course, you're not going to pay, most people aren't going to pay to buy the rate down to 4.625, or they're not going to take the higher rate of 4.75 or 7.625. You're going to take something more like in the middle. Maybe you're, looking at like the 6% or 6.25%, again, depending on that income and all the adjusters that kind of come with those facts. So that's what I'm looking at. I put in all that data in there, and I don't have to go through like remember you and I used to have to do with a highlighter, and we'd print off a rate sheet and we'd do all the adjusters and we'd add and subtract. It's all done for us right now. Thank goodness technology has improved and they make it easy for me to price a loan out. Then I can compare those against different lenders that I'm signed up with to figure out who has the best interest rate for your scenario and also who's going to have like the lowest closing costs that I can come up with. Sound good?
So just to clarify for anyone that's listening, yeah, like Jason's a broker. When that means that Jason has business relationships with several different like big national lenders. And so then once he talks to you and decides what lender is going to be best for you, then he knows where he's going to place your loan based on, what's going to give you the best pricing or whatever, what loan program meets your needs the best. Pause for a second.
Yep.
Versus if you were to just go directly to a bank, they only have their bank product to sell. And most credit unions only have their credit union product to sell. So there are advantages of working with a broker because he has access to more loan programs, more loan products, and varied lenders, which is really cool.
Right. Well, yeah, I mean, it's easy to say that brokers are better. How about that?
I think so.
Yeah.
I think so.
No, I live, eat, and breathe this stuff.
So when you're talking to a buyer and they say, well, I've talked to this bank and the interest rate they quoted me is 6.5 and you're quoting me 6.25. Why do different lenders have different interest rates? Let's debunk this myth because people think that, if they work with this guy, then they're paying money to buy that rate down. Explain how that actually works.
Yeah. So a lot of times, maybe you've got a company that is, maybe they're a broker, maybe they're a correspondent lender, maybe they are a bank, so they have a lot more brick and mortar to pay for. Let's say that, right? A lot of times they will have more expenses is what I'm getting to. I'm alluding to the expenses of, someone like myself, that's a wholesale broker, and I am the president. So I get to determine what interest rates that I want to charge my clients versus someone else who has got more expenses and they've got a boss that is saying, well, look, the company needs to take the first 1.5 points of compensation, and then the loan officer will get what's left after that, depending on the comp level that is chosen with each bank, broker, or correspondent lender. So what I probably am guessing that I see out there, and I seem to feel like I have some of the lower interest rates, comparably in the market, is that my comp level is going to be different than a lot of other lenders or loan officers can offer out there. That's probably the first thing right there. I also do have the ability to either go with no origination loans and just have the bank pay me, or I can do, origination points. Like, let's say I charge a point and a quarter as origination points, and then you're almost guaranteed to get a lower interest rate, from me than anybody else out there. But so that's kind of the gist of it, of what it is I have some of those options that, as the president, that I feel like everybody else has, or if they do have the options, a lot of times they won't exercise it. I will not mention any names of other, my competitors, but I know that some of them set their compensation at the highest level, and therefore their interest rates are higher. They will tell you that, oh, no, that doesn't seem possible, that, this person could have lower interest rates than us. But you don't understand that. You don't see that kind of information on the back end of the pricing that is baked into the interest rates of what they see and what they show to their clients.
So in essence, you're saying loan officers are making money based on how they price a loan, and you are just choosing to pass more additional savings on to the client because you have less overhead and you run a more streamlined business versus some of these big box banks.
Yeah, I don't have a loan processor. I am the loan processor.
I think a lot of people don't understand that.
Yeah. So I cut out the middleman processor right there, which saves money. I don't have a processor on salary that I have to pay, $30 to $50 to $60,000 a year to process my loans. I can do it myself because I have been so hands-on for all these decades of originating mortgages. And it's just second nature to me. And I would prefer to have that anyways, because that way I have my hands on the file and I know exactly what's going on with your purchase file or refinance file at all times. It makes it super easy for me to have that. And just it's part of my process and my system I've developed, where a lot of other companies will have internal loan processors. And those loan processors have to be paid. Those loan processors, they get a salary, they get a 401k, they get the benefits that come along with that, where I can cut out all that additional costs and offer lower interest rates because it's just me versus ABC Mortgage, in Minneapolis that, charges higher interest rates because they have so much overhead to pay for.
Mm-hmm. I love how hands-on you are, and I feel like that really adds to your level of customer service.
Yeah, thanks.
And you're just always an awesome communicator, and you literally know everything that's happening in the transaction all the time, and that's what I love.
Yeah. Yep. It works out great, and the reason is that I originate and process my loans. Let me just interject this about processing is, I worked for 2 brokerage shops before I started JMT Mortgage back in January 1 of 2005. And I had loan processors that worked for those companies. And they were not only processing my loans, but they were processing every other loan officer that worked at that company, their loans. So I never felt like my loan files got as much attention as they needed. So I still felt like I was somewhat babysitting my files, even though I was giving away some of my compensation to a loan officer who was doing the best that they could. They had so many files. Some of these loan processors, I know some of them who work at different companies around town, and they're processing anywhere from 30 to 100 files a month. Well, if you're doing that, I couldn't get as much detail or the information or stay on top of things. If I've got 5 files and you're working on 95 other files for the other loan officers, things are going to slip through the cracks. There's no way. Just human error will allow that to happen.
It's what makes your process really special. I love it.
Yeah, thanks.
Let's pivot a little bit and talk about a lot of the buzz that's been this spring is assumable mortgages. Okay. Let's talk about that, and let's talk about Explain to us like what mortgages can be assumed versus not. I mean, obviously this was really popular in the 80s when people
Yeah.
had 13, 14% interest rates, but it's become a trendy thing again when sellers have 3, 4% interest rates. And now, a buyer's like, well, heck yeah, I would love to have that, or a 2.75 rate. Heck yeah, all day long. So what does that look like? What mortgages can and can't do it? And what does that process look like?
Yeah, no, great question there. I'm not a realtor, so I don't see that side of everything that you guys in the trenches are seeing and how listing agents are trying to, portray that, hey, I've got an assumable loan with qualifications, things of that nature. I mean, the two types of loans that come to my mind that are assumable, and correct me if I'm wrong, but are going to be an FHA loan, number one. And number two is going to be a VA loan. So that'd be for like a veteran. So, the caveats with that is FHA loan, if someone has a loan that's say at 3.5% with an FHA interest rate, is if you want to assume that loan, you still have to go through the qualification process to assume that loan. And then it has to be an FHA loan. So you're basically taking over the current FHA loan at the current interest rate that the person you're buying the house has and has been paying on. That would be the first thing that for FHA. VA is going to be a little bit more strict with that. So VA loans being assumable by a veteran and a veteran only. You have to be a veteran to assume a VA loan. And again, you go through qualifications. Just because you're a veteran and you're trying to buy a house from a veteran, you still have to show the qualifications that you can qualify and that you will be able to make the house payments on that VA loan. You have to go through the underwriting process on both FHA and VA, I believe, and in order to assume those loans. And then, if you qualify, things go from there and you just take over. But as far as I know, I cannot remember in even the last 20 years thinking of any type of a conventional loan that was assumable. Because
I don't know of any either, but I'm just seeing people use it as a marketing strategy. But we haven't had any clients do it.
Yeah.
But I think it's just a way to like get hooked.
Yeah. Well, one thing you got to remember is if you're the listing agent or if you're a buyer's agent and, you're reading the listing on the MLS that says that, okay, the seller's loan is assumable. If I was there, whether I was their listing agent or a buyer's agent interested in the property, I would want to see the current mortgage note. So I want to see the note of repayment that was signed by the person who took out the mortgage before I solicit that as assumable. Or if I'm a buyer who a listing shows that it is an assumable mortgage, I would want to see that. I mean, you can white out all the personal information about names or whatever it is on there that you want to white out. But the note is only typically like a 3 to 5 page document, and it's going to show the assumability in that right there in the document. It'll tell you whether it is or is not.
Okay.
Because I had a friend of mine.
Have you ever had anyone do that process? I never have. Even when I was in the mortgage business, I never did anything with assumptions. Did you ever?
No, I have never had anybody come to me and say, "Hey, I have a house that's assumable. I want to, assume this mortgage. Are you involved with it, Jason? How does this work?" So no, I never have had anybody do that. I mean, it's definitely a marketing tool right now when things are tough, especially with higher interest rates, because it could easily be that the interest rate may be double right now what the person who has the assumable loan on the listing side, has to offer. It's a huge selling point.
Totally. Yeah. I feel like it's more of a marketing tactic than anything, but at the end of the day, I don't feel like people are actually taking advantage of it as much as what maybe someone would think they might be.
Right. Well, let me point out one other thing. I live in Victoria, Minnesota, and I had a local friend of mine tell me that his neighbor, who I had refinanced back during COVID, like I think it was probably 2020. I don't even think it was 2021. I had given him an interest rate below 3% on a 30-year fixed. And this neighbor was going to turn around and put his house up for sale. And I knew I had given this person a conventional loan, and the listing agent was marketing that loan from the sell side as assumable. And I knew for a fact it was not, but it was catching traction, and I would hate to be a buyer who thought, oh, maybe I could assume this person's loan between 2.5% and 3% interest rate, when rates are at 6 or 6.5 or 7, and then come to find out, oh, actually I can't because their conventional loan from their refinance in 2020 is not assumable.
Yeah, it's one of those things I feel like it's sort of buyer beware, and you really have to cross your T's and dot your I's before you try to go down that route. And it might, it might be one of that old adage, if it sounds too good to be true, it might actually be too good to be true.
Yeah. How about this one? What if you say, don't assume it's assumable?
Nice. That's real punny there, Jason.
Yes. Thanks.
Okay, let's pivot into something like a couple other random weird questions. This comes up every once in a very blue moon. How about getting financing on like mobile homes or modular homes?
Okay.
Tell our listeners like how that all works.
If you are trying to go for a purchase of one of those two types of homes, modular or mobile, I currently do not have any lenders who want to go after mobile home financing. The biggest indicator of a mobile home is going to be a red tag about that big. Maybe a 3x5 red tag that is going to be on the outside of one of the corners of the mobile home. It is riveted to the home, usually to the siding or something like that. Or otherwise, there may be something underneath, like let's say the kitchen sink or one of the closets inside of the home that details out the information about the home being mobile. So I think that none of my lenders want to touch that type of property because they have to turn around and they have to sell this loan, through Fannie Mae or Freddie Mac. And it's not the type of property that my lenders are going for. So I have not done a mobile home financed house since probably 2005.
So I'm shocked they were even doing them then.
Yeah. And it was not easy back then. So I think that, mobile home financing, that's a niche market where those people who are selling mobile homes, they have specific banks that want that business. And if you're buying new, you're probably best going through that type of a bank that the builder can refer you to. Or if you're trying to buy an existing mobile home, is find a local bank where that's more the norm of that type of a property there, and you may have better luck with that.
Okay, good to know.
Let me switch gears real quick. You asked about modular homes. Just because, my background of not only doing mortgages, but at one time doing real estate, also doing appraisals for a couple of years. I have some more of that expertise in my past, running through clients and appraising houses and stuff. Modular homes, those can get done more easily on like a conventional side that I've seen, and I've done modular home financing. Again, you're not going to have that red tag on the outside or underneath the kitchen sink that designates that as a mobile home. And that's the one thing where people come to me and ask, hey, can you do financing on this house? I'll look at the listing of the house and I'll say, look for these tags. We got to determine whether it's mobile or modular. If it's modular, I have had success getting modular financing done. And the reason probably I would say this is that if you're buying a modular home, let's say that it's an existing home, in the area that maybe say where that modular home is, there needs to be additional comparables out there from an appraisal standpoint that show other modular homes in that area have been sold.
Okay. That's good to know.
Yeah. I mean, because there are some very, very well built, stick built modular homes that are placed on a permanent foundation. Okay. That I should point out is one of the big keys there is a lot of times the mobile homes will not be on a permanent foundation, and I cannot do that financing. I think that's more difficult to get done. But a modular home that is on a poured or a block foundation, a permanent foundation, that's where you're going to have success with financing.
Okay. That's good to know.
Yeah.
If somebody's got like a really sexy low interest rate, can that be transferred to a different property?
The interest rate. Are you talking about like if somebody's trying to buy a house?
So you're like, I have a 3%. Yeah, like someone has a current house and they're like, I have a 2.75 interest rate. Can I move that to a different house?
Oh, thanks for the clarification. The answer is no. That interest rate is tied address and borrower specific to that property.
Okay. What happens when if someone is buying a home and interest rates either go like up or down and they're in the middle of the loan process with you? Like, how does that work? Like, let's say some miraculous thing happened and someone's like in the middle of underwriting, they're like 2 weeks before closing and interest rates drop a full point. And they're like, well, I don't want 6%. I want 5%. What happens then?
Well, I can answer that a couple ways. I'll try to keep this as simple as possible. Not all lenders will allow a renegotiation. So renegotiating would be in the instance where I lock you to an interest rate of, say, 6%. And, a lock is a commitment. People have to realize that. Of course, with Americans, they always want to have their cake and eat it too. So they feel like, there's some entitlement there.
What?
Yes. Let me touch on the entitlement conversation here. People feel like they are entitled to a lower interest rate, even though they told me to lock their rate in on a specific day. And they understand that if rates go up or if rates go down, I cannot renegotiate their interest rate. So that's generally my stance on this. One of my top lenders, they do not have a renegotiation process for if rates go down. If rates go up, obviously nobody ever calls me and says, hey, I heard rates went from 6% to 7%. I want that higher rate. It's always that they want the lower interest rate. And so with one of my top lenders, they do not renegotiate. A lock is a lock and a lock is a commitment. And people have to understand that. I do have another one of my top lenders that does have a renegotiation policy. And what theirs is, I believe if I'm saying this correctly, is that the interest rate has to move by at least a minimum of 0.25% down from the original locked interest rate. It can go down to a max of 0.3% less than the original lock. And then there is a 0.5% hit to the new pricing when I go back and look at renegotiating. So the renegotiation is not free. People need to understand that typically. Yeah. So it's not a cost that you pay out of your pocket. It's just a renegotiation, 0.5 point pricing loan hit that I have to look at the new lower interest rate when it comes to possibly, looking at relocking you at a lower interest rate.
So what you're saying is with some lenders it's possible and some not.
Yes, I would never guarantee it. I mean, you could probably err on the safe side and just think, a lock is a commitment. And if rates go up or rates go down, you got to be happy with that interest rate, because I'm not going to ever hold a gun to anyone's head and tell you that you have to lock. I am always of the stance of if you lock it, if you love it, you lock it. How about that?
Yeah. So one thing that we're seeing a lot with our team this spring is sellers that so sellers, they're like, they don't have their house on the market yet, but they have the ability to purchase their new home non-contingent, meaning they don't have to sell their home in order to buy their new home, but they have a lot of equity tied up in that first house. Yeah. So they buy the new house, and then usually we're sort of selling the other house kind of at the same time. But if the closings don't line up, and then they say, well, I want to take $100,000 from my old house and then pay down my mortgage on my new house, what does that look like? Talk us through that and the steps for that and why that could be important to somebody.
Yeah, I think it's very important. I think it's really critical here in the last 2 or 3 years that people understand that they don't have to sell their existing home if they can qualify to go non-contingent, and they can qualify for both house payments plus their student loans and their car payments and their credit card minimum monthlies. That's fantastic. That's somebody who's in a great financial position, that you don't have to sell that house, that you can get some of that equity out with a couple ways. Number one is you could take out a second mortgage if you wanted to tap into that. Well, that costs money and that takes time. A lot of times we don't have the time to go through the underwriting process when it comes to that. But the process that I think all my lenders allow is what's called a recast, RECAST. You can buy your new house non-contingent, close on that new house. Maybe you only put 5% down. And then after you sell your old house, that like Beth, you said, is that you have it under, the process of selling anyways. Maybe you even have it under contract and you're going to close on the sale of your existing home a week or 2 or 3 weeks after you purchase the new home. Then when you get the proceeds from the sale of your old home, you contact your loan servicer and say, hey, I would like to take care of this recast process. You don't have to go back through underwriting. They have a very fine-tuned step process of what you need to do, about 5 different things. And I think it only costs you typically about $250 to have your loan recast. So remember with the recast also...
And explain exactly what that means.
So the recast, yes, is that specifically if you buy a house, you take out a loan for $300,000 at 30 years at, say, 6%, you're going to have a certain principal and interest on that loan for the life of the loan for 30 years. So if you go through the recast process, and now that you you send a check to the loan servicer, say for $100,000, all that you're reducing is the principal and interest amount that you're going to pay monthly. So instead of, having a $300,000 loan, you give the loan servicer a check or you wire them the money for $100,000. Now you go from $300 to $200. It's still amortized over 30 years, and then the interest rate does not change. That's a key factor there. People have asked me, well, does the interest rate change, or do I, go through underwriting? No. All that changes is the loan amount changes, and your principal and interest changes. For $250, you take out a lot of stress in your life.
Mm-hmm. So if you had, and this question just popped in my head. So if you had mortgage insurance and you put enough money down after you sold your house, where now you were under, you had less than an 80% loan to value, could you drop your PMI right away, your mortgage insurance?
100% yes.
That's awesome.
Yep. So you can start out.
I don't know if buyers really know about that.
Yeah. You may only make even one payment of mortgage insurance. I don't think there's a minimum of how long you have to keep that loan, before you can do the recast. I think that, talk to your loan servicer after you buy your new house. Don't talk to, the mortgage person, talk to the title company. They're not going to know specifically. Talk to the loan servicing department of the lender you'll be making payments to, and they can describe how that works.
That's so cool. It's so shocking. When I'm meeting with sellers, and after, they've talked to you and gotten pre-qualified to buy their next house, it's so shocking to me that so many of them, outside of talking to you and I, they don't even know, they've never heard of it before. They don't even know it was an option. Because I think most people know that they can just write a big check to the mortgage company and that there's no prepayment penalties anymore. Mm-hmm. But the fact that you can make a big lump payment than get a lower house payment every month is super attractive. I think people are like, oh, wow, I had no idea that's even an option.
Yeah. Yeah, it's great. It's something that, you really didn't hear about that so much until the last, 4 or 5 years or less.
Yeah, I would say, I don't know. I feel like it's become super popular in maybe like the last 2 years. Now everybody's talking about it. And maybe the fact that because everybody has so much equity in their homes right now.
Yeah. Yeah, because it's a wonderful thing to have so much equity in your house. But as you and I both know, Beth, there's only two ways to tap into that equity. One is refinance, and two is to sell the house. And if you're not selling before you're buying, you may have to do that one extra step, to get your loan recast. Because if you don't go through the recast process and you just send the bank $100,000 to go towards your loan, all it's going to do is reduce the principal balance. It's not going to change your monthly payment because you didn't request the recast.
Yeah.
Yeah.
And maybe that's not important to some people, but I feel like, younger families and they're raising kids and like doing the thing. I feel like having a lower house payment every month would be really advantageous for a lot of those buyers.
Right. Well, especially with Beth, as you and I keep getting older and older, and when better like a fine wine, is that our buyers seem to, a lot of them keep getting younger and younger. Am I right?
Yeah, it's crazy. We've had, especially in the last few years, you and I have had a lot of clients that are like early to mid 20s. Mm-hmm. And I think it's incredible that these buyers are getting into the market now, because I think of like, they're just going to use real estate as a stepping stone, start out with that little house, and eventually, you buy acreage or build your dream house or whatever that looks like. It's so smart that these young buyers are getting into the game when they are.
Yeah, they're building equity and they're building wealth, in a very, very, typically a wise investment. Hopefully we just continue to see, home prices go up at a steady pace, and, you're not going to lose out on that. I mean, I don't think overall, historically, you're going to lose out on investing in real estate. Would you agree?
Oh, yeah. No, it's one of the most solid investments out there. But I always say, every once in a while you can, flip a property and have it be a short game, but you really have to know what you're doing there. But more often than not, real estate's a long game. So if you put your money there and invest it, and you're taking care of your property and paying down your mortgage every month, it's like a forced savings plan. It's so smart.
Yeah, definitely.
What about those buyers, or those sellers that have that starter home with an awesome interest rate, like the 2.75 interest rate, and now they're wanting to buy their next home, but they're like, oh, I don't want to give up this house with this really awesome interest rate. And they say, okay, Beth, I want to keep this first property as an investment property, and then I want to go buy my next property. How do the logistics of that work out?
It's really, really simple. It's typically, I can take care of any questions with an underwriter on what's going to happen with the current real estate owned property. They want to know that, like, if you are going to take your townhome that you bought when you were single, that you and your family have started to outgrow, and you're going to be buying a single family that you're going to hopefully live in for, a number of years as your family grows. You keep that townhome and you can turn that into a rental property, and you don't have to refinance. You don't have to do anything with that. That's typically the way it is. I might have a letter of explanation that is filled out by the buyer or buyers of the new home, and nothing changes.
So, but like from a qualification standpoint, then you have to calculate the payment on this townhouse and the new house, or talk through that a little bit?
Yeah, that's a different level of detail. There are two ways typically that it can happen. Is that, for example, if you own a townhome or a condo in Bloomington and you want to buy a house in, like, let's say Minnetonka, is that if you qualify for the new house payment plus the old payment, you can qualify for everything there. and then no big deal on that. But if you don't qualify for both house payments and you need some rental income from the departure residence, the home in Bloomington that you're trying to hold on to also, you can, there's ways to get around getting some income credit from that with a signed lease prior to going to closing, and we can offset some of that monthly payment.
So then you don't necessarily have to be paying both the house payments. A lender, there's options.
There are options, yes. Yeah, and it's good to have those options because that's
so good.
Yeah, I've seen that. I know you and I have some clients that have got a place in St. Paul, and in the past they've thought, oh, well, we're going to buy a new home because we now have 2 kids and we're going to turn our existing condo into a rental. So I went through all the underwriting guidelines. I found out exactly what we needed to do that in order to make that happen so we could offset that $2,000 a month condo payment, while they were trying to buy a bigger house, a single family. And it's an easy process to get done. And I mean, it's just documentation and paper trail is the name of the game.
What I love about that also is that it's a great way to build your wealth portfolio too. It's like you have this primo property that's probably going to be really easy to rent, and you can potentially cash flow it because you have such a low interest rate. And so that, you're just building wealth, and every month that your tenant's in there paying your mortgage for you, you're making more money. You're building more financial, you're fixing your financial well-being. And I think that is such a really cool tool. Carrie on our team had recently sent out an email, and she's like, regrets in life. I don't have many, but my one regret is that they sold when they had moved to their single family house, just, right down the street from where their original young married townhouse was. They kept it as rental property for several years, and then they ended up selling it. And she's like, if only I had a crystal ball to see what things would have done and how hot the rental market would have stayed, it was staying. She's like, we would not have sold that property. She's like, now I'm kicking myself. And so that's just a good reminder to people. And every time I meet with a seller, I'm like, here's all your options. Doesn't always have to be selling. I mean, obviously I love when people sell because then I, make more money. But at the end of the day, it really needs to be about I have a fiduciary responsibility to my client to make sure that I'm working on their best behalf. So I need to present all the options, maybe keeping this property and renting it out is an option that's really great for people.
Yeah. Yep, it is. It's great to have all those options out there.
Totally. Yeah. Okay. So this was a super awesome conversation with you, Jason. I feel, this is, you and I are in the trenches. You and I are talking, every single week we're checking in and talking about clients that we're working together with, and, just talking about the market in general. And I'm feeling encouraged. And one of the reasons I love working with you is that you're glass half full guy. Yeah. And I think the market's hot, and I think the market is off to a really great start this spring. What do you think?
I think it definitely is. And I'm very optimistic, especially coming out of the winter months. The winter months were definitely slower for me than I was anticipating, but I am busier right now than I have been yet, 4+ months into this year. So that's very encouraging for me to have a full rack of files here right to the left of my computer. That's great. And these are buyers buying in Minnesota who are, a lot of them are first-time home buyers that are, some of them are getting into multiple offers and winning. Some of them are not. Some of them are having been able to get some closing costs paid by the seller. Some haven't. It just seemed, it kind of ebbs and flows with the amount of pre-approval letters that I write. So when somebody comes to me and says, hey, such and such referred me to you, I need to get pre-approved, I can't wait to get that conversation going because I get to tell them about me. I get to tell them about the loan process. And it is an appointment that I get to add to my calendar that helps give me structure outside of, sports and, hanging out with my wife and hanging out with the kids and going to the fire department. I love those meetings. I had one yesterday afternoon at 4:30, and I had already talked to this girl 2 weeks before. She had already given me her pay stubs, her W-2s. So I was looking at her commissioned income. I already had that all figured out. And, it just makes me feel good to be able to pre-approve somebody in an hour or less to buy a home, whether it's their first home or an investment property or their next home that they're going to own or occupy. It's a quick and easy process that I love to have multiple, pre-approval dates, appointments on my calendar each week. I look forward to those. That's one of the big highlights of my week. Otherwise, going through underwriting seems to be very, very fast right now. I know that, there's a lot of underwriters working for a lot of the big wholesale lenders that I send loans to. So they're very well staffed. Those lenders are really looking for ways to help the consumers, looking for ways to help me to help the consumers also. Credit repair is one thing that one of my lenders has been able to offer, free credit repair service. So if you've got a credit score under a 750, I can take your credit report, upload it to their secure portal, and they will go through it. They have their people there who will go over the credit report and see, is there ways that we can suggest to help improve your credit scores to get you lower interest rates when it comes time to lock in and buy your next house. So underwriting.
That's a hella awesome offer.
Yeah.
That's so freaking cool, Jason, that they offer that. I don't even know if you and I have ever talked about that. It's fabulous.
Right. I, knock on wood here, I do get a lot of good credit clients that don't need that. Or they're just right on the border of having like excellent credit and they don't really need a lot of credit counseling or hand holding there. But one other thing that's really encouraging here, Beth, is I'll tell you is that, there's a program out there right now that not all lenders have, but one of my lenders has a grant program. And I know I've put it out there to you and to some of your team members that, hey, look, I've got 3 first-time homebuyers right now that are taking advantage of free grant money. So it is an income-based program. And for me to actually have 3 buyers right now in underwriting that are taking advantage of this free money through what's called the Home Preservation Foundation, it's amazing. It is amazing. It's either, depending on your income, you will receive $2,500 or half of that at $1,250. And you go through a counseling service. There is a $99 fee that you do have to pay for during the counseling process, but then it becomes free money. This isn't like a down payment assistance program through the county that gives you money towards closing costs or down payment. This is just free money. And I've got 3 of those going right now. I think this program started last summer. I don't know how long the funds will be there, but it is a great tool. And I'm very, very excited to have, clients that are taking advantages of this right now. And it's just amazing. It hasn't been there forever. I don't know how long it'll be there, but hopefully before it goes away, my lender will let me know as the funds they're seeing as they're going to dry up.
Yeah, a lot of times first-time home buyers, they ask all the questions like, oh, I want a first-time home buyer program. Well, those down payment assistance programs, they're great and there definitely is a time and place for them, but those are loans that you have to pay back. Right. And they're not, every once in a while, there'll be a forgivable type scenario, but generally speaking, those are ones you have to pay back. But like the grant money is great in that you don't ever have to pay that back. It truly is a grant. And all you have to do is sit through like a 90-minute first time home buyer class or something like that. And learning stuff an hour.
Yeah.
1 hour. Of learning stuff that you need to know anyways about home ownership.
Yeah.
It's great.
Yeah, of the 3 clients right now that I'm working with, I have asked each of them, have you found that counseling class beneficial? And 2 out of the 3 have said yes. It was very, very beneficial. The one that did not think it was as beneficial was someone I can tell you that had already self-educated himself, just through the internet or talking to people like me or talking to his parents or whoever it was. He had a lot of advice ahead of time and really had a good head on his shoulders prior to obtaining a loan. But the other 2 have said, yeah, it was great. I didn't feel like it was a waste of my time. And I feel much more prepared to buy a house based off of that class and all the information that, Jason, you have provided through the underwriting process.
That's awesome. That's so awesome. Yeah, I feel like there's a lot of really good wins happening out there in the marketplace right now.
Yeah.
And like partnering with an awesome lender, that's one of the reasons our team loves partnering with you, is that the left hand's always telling the right hand what's happening. Our clients are all getting serviced at a super high level. And like we're winning in these multiple offer situations, and our clients are getting into homes with low interest rates, as low as of interest rates as they can get out there right now. And I feel like it's a whole bunch of good things. So like all these naysayers are like, oh, the market's terrible. I just have not drunk that Kool-Aid, and I have no intentions of drinking that Kool-Aid. And I know you aren't either.
Yeah. No, I think that it's, both for you and I mean, we love what we do, and we like to convey that to others around us and surround ourselves with good, positive people that, are willing to work 7 days a week. Depending on, what the circumstances are for these buyers and whatever it takes to get these people into these houses and get these offers accepted, get them through home inspection, get them through underwriting without any hitches, and get them to the closing table with no surprises is the name of the game.
Absolutely. I feel like you're like mic drop. Oh,
that's all I got. I got a highlighter.
Jason, like this. You got a highlighter drop. This was such a good informational episode. Most of the stuff is stuff that I already know, but like I actually learned something new today. And I hope that all of our listeners learned something new today too. So Jason, tell us where our listeners can find you. What are like social handles and all that good stuff?
Yeah. Usually, like I have a lot of people who reach out to me, who get referred to me by their realtor. They will say, hey, I got your name from such and such, and, I need to look at buying a house. I want to, connect with you. Please let me know the next steps. I get that next step piece quite often. So I've got a very well-crafted reply email to that. And again, I'm looking forward to so much setting up that verbal meeting where we're talking over the phone. We don't need to meet face-to-face anymore. I like to be efficient as I work through the process of getting someone pre-approved. I can do that over the phone. I will do face-to-face meetings if necessary, but 99% of the time, everything can happen over the phone. So whether it's you could just email me or people will call me or text me. Again, I like to say 7 days a week. I try to make my hours from 8 in the morning to 8 at night, 7 days a week. I don't think there's everybody that does my job, makes themselves available, in that kind of a capacity. And it's working out very well for me. Mm-hmm. I guess on Facebook will also be another one right there. I'm not on the gram, so sorry, Beth, you're not going to catch me there.
And are you JMT Mortgage?
Yeah. So,
are you JMT Mortgage on Facebook?
I do have a JMT Mortgage page, yes, and obviously a personal page. But I'll just say that even on this, can I throw out my phone number right now as the easiest way to get a hold of me?
Sure.
And
totally.
That number, to reach me by cell, whether it's a phone call or text message, is 612-964-8898. Call, text there. You can email me at jason@jmtmortgage.net. That'd be the other way of getting a hold of me, and we can take the process from there and get that pre-approval process started, because you can't write an offer without a pre-approval letter, and Beth doesn't like showing you homes without you being fully pre-approved.
True story. True story.
Yeah. So, yeah.
Well, thanks, Jason, for being here today.
Yeah, thank you.
And with that, until next time, bus bench babes, keep your face off a bus bench and keep being the badass boss babes that you are.
Okay, girls, are you feeling as inspired as we are? We're over here cheering you on because you just finished another episode of the Girl, Get Your Face Off a Bus Bench podcast.
If you want more, head over to girlgetyourfaceoffabusbench.com for show notes and more episodes. And don't forget to subscribe and leave us a 5-star review. They mean the world to us, and they're what keep us going.
Girl, thanks for being here.